You have a particular viewpoint from an investor's point of view. You represent a lot of high net worth and ultra high net worth individuals. Start with geopolitics, because they're very much in the news right now. To what extent are those investors focused on geopolitical uncertainty, and if so, what do they do about it?
Well, investors, David, have a hard time measuring geopolitical risk. And history would suggest that a lot of the immediate downturn that occurs on the back of different geopolitical events tends to reverse over the following months. So the big issue in a place like the Middle East today for investors is, does it expand? Will it move into a regional conflict, bringing in nation states like Iran, and then ultimately impacting things like the price of oil that would have an impact on the global economy? You know, if you look at local markets in the Middle East today, they've had a fairly moderate reaction, down a little bit. The Israeli stock market in Tel Aviv was off the first day, but has been in a range since, so that even the local players so far are measured in response. But our investors here in the U.S., no fundamental change at this point in time, other than sitting here and witnessing these unimaginable horrors that the rest of us are watching. From an investment standpoint, they're similar to where they were before this.
When you talk about fundamental change, we've seen a fundamental change in the rate structure. We were essentially with free money for an awful long time, essentially zero rates. Those days are gone. It looks like we're going to have higher rates for some time to come. How do your investors take that into account?
Well, that's a big impact on investors, and that's something that they're all digesting. So, at the outset, when you look at stocks and stock markets, the risk premium that stocks bring today now over other attractive alternatives, even cash, but munis, treasuries, things like private credit, which is a big growth area for us within our alternative business, that risk premium is down on equities. The reality is, with higher rates, growth companies, you're discounting back cash flows that are out there in the future that are going to grow between here and there. You're discounting them back at higher rates. So from an equity market standpoint, the higher rates are a serious headwind, particularly when you have the kind of alternative uses of investor dollars that we're seeing. And as I said, even cash, if you can get 5% on a risk-free basis in something that liquid, that presents a positive alternative for investors. The other thing I would say about higher rates is the impact from a fiscal standpoint, which I know you spent a lot of time looking at. On the current trajectory, interest payments on the federal budget will exceed military expenditures by 2027. So higher for longer has a big impact on the fiscal side of the equation, which is relevant to all investors, because the U.S. debt situation is definitely a concern.
And what overhang might that have for growth? Because your investors must be thinking about, what are our growth patterns? What are we looking at over the next 5, 10, 20 years?
Well, the U.S. economy is held in remarkably well. There's a number of reasons for that, including the fiscal spending. I mean, we're running a federal budget deficit now of 8% of GDP, and there is no recession. Typically, deficits go up when you have a recession. If we have a recession, you could see a double-digit deficit as a percentage of the federal budget. So with that kind of fiscal spending already embedded in the economy, will there be enough growth for investors in the U.S. market? It's a real concern that the fiscal side of the equation could be a headwind for investors going forward. So you have that investors are focused on. And then you have the Fed, who's obviously been raising rates to try to deal with inflation. Those higher rates are also working their way into the fiscal situation. So you have a headwind on the monetary policy side. You're likely to have an increasing headwind on the fiscal policy side. So investors look more cautiously at the medium-term outlook for the U.S.
Your high net and ultra high net worth investors must be thinking about taxation. And when you talk about the fiscal challenges we have in front of us, one possibility is higher taxes to raise more revenue. How do you invest around that potential?
One of the things that we do with our investors is we work with them on a comprehensive basis across all of their needs. So we're helping them with generational work, we're helping them with estate planning, and already, even if taxes don't go up at some point in the future here, already you have tax cuts in 2017 that are scheduled to expire at the end of 2025. So we're spending a lot, and the estate deduction, the ability to leave money without paying an estate tax, that amount is coming down if those taxes are rolled back. So we're already spending a ton of time with clients on a longer term basis looking at tax policy from that vantage point. So taxes are a big part of the work that we do. We have a group called our Wealth Strategies effort that works very closely with our private advisors and our clients on pre and post tax planning.
Talk to us about geography, both in terms of your customers and your clients, the money coming in for you to manage, as well as your investments going out. I know you have offices all around the world at this point. How much of it is U.S. based?
Our client base is almost entirely U.S. based, and our offices that work with high net worth and ultra high net worth clients are all in the U.S. We have a London office that is focused on distributing our asset management products through different intermediaries in Europe. So the Rockefeller Global Family Office business is really a U.S. business with U.S. clients. The reason that we've stayed focused on the U.S., even though we have this name, Rockefeller, which resonates not just in the U.S., but around the world, and we could be expanding outside the U.S. with that name more, is because the opportunity has been so significant for us here. The breadth and depth of wealth in the American market, the number of cities that we can open an office in, hire private advisors and start to build a business around is significant. So it used to be, David, if you went back 10 or 20 years, there were 30 or so markets in the U.S. that would be quite attractive for helping high net worth clients. Today, we're in 47, and we could end up with over 50. There are relatively new markets that are quite strong from a growth standpoint, creating a lot of wealth for different families in places like Nashville and Austin and Charlotte. So we've really expanded the footprint to include some of these real growth areas within the American financial market.
And what about investment opportunities? I mean, at this point, for example, China is not as attractive for many investors as it once was. If you look at direct foreign investment, it's really gone down substantially. But what are you looking at globally, United States versus Europe versus Asia?
Well, first of all, the U.S. Continues to outperform on a lot of bases, and the economy has been very resilient in the face of 500 basis points of Fed increases. Now, part of that, again, goes back to the fiscal stimulus that's embedded in the system, the payments to individuals during the pandemic, and that's still in the system a little bit. So the U.S. remains an attractive base for a lot of our investors. On an international basis, the rivalry between the U.S. and China has created some other markets that are more attractive when you look at emerging markets, including places like Vietnam and Indonesia. And there are going to be markets that kind of, in Mexico, where more things are being made there again, and some of the restrictions that have been applied to China have benefited the Mexican economy. So as the U.S. and China continue to face off against each other in different ways, there will be economies around the world that benefit from that. Some of the places that have been challenged for a while are still challenged. I mean, Europe is probably the most difficult place in terms of growth and investing for our clients.